Hello and welcome to the download. I'm your host, Dave Richardson, and always exciting to have our good friend Scott Lysakowski, Managing Director and Head of Canadian Equity at Phillips Hager and North. And Scott, great to have you back, by the way. Just probably
Thanks,
start
Dave.
with
Good to
some
see you.
niceties. Yeah.
Yeah, it's been a while. It's November, so it's getting dark. Sometimes I feel like it gets dark just after lunch here, and the days of rain are piling up. But I am well, actually, you know what? Today is a very important day because today is opening day at Whistler Blackcomb. Well, that's a good sign for me and my family that we can be dodging some of this darkness and heading up into the mountains and get some skiing in. So opening day.
Oh, you
It's a
you
great
zipping
day.
up? You zipping up there today over the
Not
weekend?
today. I think we're gonna go next weekend. So it's the early season stuff is it's for the diehards. You got to use your we call them rock skis. You
Yes.
don't have the full coverage just yet, so you don't want to get the use the good stuff on in the early season. So we'll be using rock
You
skis
know where
next
you
weekend.
where you got to stop. We were just talking about some food recommendations because Scott's going to Regina and Winnipeg this coming week. So, beverage and coffee recommendations. So, Winnipeg's good. Regina's a little tough. So, we'd love for some of our fans in Regina to come on and give us some tips there because the coffee scene is since 33 and a third went under. It's been a little rough, but you need to stop with your family at Backcountry as you
Oh,
go through. Have you been there?
big fan, big fan.
Big. Oh, and the
Do you
pizza.
go? Yeah, well, the fan of the other, their main offering is beer. Um, big fan of the Widowmaker hazy.
Oh, yes. And you need to try the Maple Bay, which they brought out as a sort of an adjustment to the Widowmaker, and you'll love that. So we're not allowed to talk about that on this podcast, though, Scott. Just so you know, we can talk about coffee, and then we can only
Right.
talk about other beverages. We are limited here on a corporate podcast.
And no free ads unless we're getting, you know, benefits from it.
Well, I'm okay for we don't need benefits either. We love to support the business community in
Support
Canada.
the local
That's what we're
businesses.
here
That's
for.
right.
Just like you as a massive investor in Canadian businesses.
That's
So
right.
Scott, we got lots of stuff going on in markets right now. I'm sure we're gonna have a really fascinating conversation. But you always show up with a few numbers and a few things that you're looking at and thinking about with respect to the Canadian market. And I know you always show up prepared. So what have you got this morning?
Well, yeah, as you mentioned, we're heading out on the road next week to do marketing some of our newer strategies. So we're updating on markets, and given that it's November, we're almost through most of the year. So year to date, TSX has been very strong. I think year to date we're up sort of total return in the 23-24% range, which across all equity regions globally, that would be among the best. EM is just slightly ahead of Canada. So it's been a very strong year. A couple things to note from that performance. Obviously, the big driver of performance in Canada has been gold. It's contributed close to a third of the return for the sector. So gold stocks very strong. Gold stocks up close to 100% so far this year. So that's spectacular. And
Yeah.
they actually had been strong coming into this year. So gold's been on a spectacular run. We could talk about that a little bit later in the conversation. But even if you sort of back out that gold's contribution, the TSX X gold is still slightly ahead of the S&P 500, which is interesting. So that relationship has changed a little bit this year. Typically, the TSX have been lagging the U.S. this year ahead of the U.S. So that's something of note.
And
The other thing
Scott,
I
we
would
should
note,
we should note too that we've been talking about that for a couple of years now. The
oh
idea
yeah,
that we
yeah,
we expected, and it's really about an 18-month outperformance that the TSX has had relative to the S&P 500, and then particularly when you're talking about in Canadian dollar terms. Although that's ended up being fairly even this year, but the previous 6 months you'd had a little bit of a move in the Canadian dollar. So
well, yeah, and
it's
that
added to the yeah.
relationship that we've probably talked about is you talk about 18 months. Um, and that relationship is really a long duration relationship. The periods of relative performance are typically not measured in 1 or 2 years. They're actually measured
Sure.
in 10. And so we know that Canada has underperformed the U.S. relatively speaking for the last 10 plus years. And so, I'd like to think that this 18-month strength and change in that relative relationship sort of is a bit of foreshadowing for the years to come. But the one thing I was going to note is that in the sector contribution of returns is that typically when Canada in a market where Canada outperforms, it's usually those cyclical sectors that Canada is
Yep.
has so much exposure to: energy, financials, industrials, and materials. So materials are leading the way, but that's really the gold component of materials. So that's a less cyclical component of gold. And then the other components, financials are strong. Banks are ahead of the market, which is good. They've sort of been lagging the market for the last 1 to 2 years, and really have been very strong, and really have been strong off that March April low that we saw. But other sectors like energy and industrials have been lagging. We sort of talked in our pre-comments about some interesting things happen in the energy stocks, and we could talk about that. But industrials have been pretty weak, particularly the rails within Canada. They make up a big component of the industrial sector. So that sort of tells me a couple of things that if we do sort of get that more cyclical participation from more broadly, thinking beyond financials and gold, even though it's not so much cyclical, but seeing some participation in the cyclical sectors beyond financials, seeing energy sort of follow through with some of the recent strength we've seen, and getting industrials to finally participate more broadly. I think that can actually, there's some more gas in the tank, I think, in terms of the relative performance of the TSX. So that's something that's worth noting. Here's
Yeah.
my sort of
I
stat of
guess
the.
the
Yeah.
I guess the other, just before you give your stat of the day, so we'll pause. We'll do a tease on the stat of the day. But I think the other thing we should think about, because there's a lot of talk about AI and AI bubble, and you're seeing some volatility, particularly in the tech sector in the U.S. And one of the things about the Canadian market, and we've talked about this in the past, is you don't have that massive exposure to tech in the Canadian market. So if we are actually going through a rotation out of tech, and it's a little premature to suggest
Mhm.
that that's exactly what's happening, to put a nail in the coffin on this AI frenzy and the relative strength of tech. Canada is underweight in technology.
Yeah, relatively speaking to the U.S., and would not have the same level of exposure, of course, or at least direct exposure. There are a couple names that are participating very directly in the heart of the AI capex boom that we're experiencing today. And then there's some other bigger technology companies that would be more of a beneficiary from AI as a user of it in their platform. So of course, we think about that AI sort of trade and the sentiment around it, because it is driving markets globally. We don't need to sort of dwell on the concentration. That's more of a U.S. equity sort of comment, but that the concentration, and even just thinking about the amount of the S&P 500, whether it's the earnings pool or the valuation or just the sentiment in the S&P 500 that's driven or attached to this AI thematic is becoming quite large. And I'm definitely not a bubble guy. I think you
Yeah.
can. It's something that people like to talk about. It's very interesting for conversation, but that's too hard for me. So I will sit that discussion out. But we're very aware of the implications that it has, and I was even commenting to some of my teammates that we were watching the Nvidia earnings very closely, and Nvidia is not a stock that's in our benchmark or in our portfolios, at least our Canadian portfolios. So I thought that was a very interesting observation of the behavior of markets, like all eyes glued on this one company's earnings report, even though we don't have a lot of direct exposure to it. So that's
Yeah, and
something to
and we
note.
we we kind of think, like, as I always say, when everyone's talking about a bubble, you're usually not in a bubble. Bubbles
Yeah,
usually
that's
kind of
right.
sneak up on you, and you don't really notice. And
Yeah.
uh, and and I think we should also note that similar to the internet, and when the internet stocks kind of got ahead of themselves, even though the internet was going to be life changing, just as AI is going to be life changing and change the way we do business, the stocks can get ahead and pull back. But from a Canadian standpoint, the one thing we know about AI is that it needs endless supply of energy, and geez, here
Hmm.
in Canada, we're really good with that.
Yeah,
And
yeah, and we can talk about that. The one stat I was going to share with you is that
oh, okay,
you
stat
know
stat stat of the day, stat of the day, stat of the
stat
day.
of the day. So the thing that when I talked about gold making a large contribution to the return of the TSX, that's true. And it's a big driver of the returns, but we are seeing breadth across the TSX, and I think breadth is something we've talked about in the past. And I was mindful that my mom listens to this podcast, and she had no idea what I mean by breadth. But breadth means seeing strength in an overall index or an overall market, and it's not driven by a small number of stocks. We're actually seeing it, participation with a wide number of stocks. And there's one of the ways that we manage breadth, or measure breadth, is the percentage of stocks above their 200-day moving average. And so that's more of a technical term, but it is just a measure of the health, the overall health of a market. And the TSX is one of the strongest markets in terms of breadth. Close to 80% of stocks in the TSX are above their 200-day moving average. So it's that strength is not just in gold. We've seen strength in a number of places. Now, the distance that they're above their 200-day moving average could cause a little bit of concern in terms of if we do see a little bit of a pullback, consolidation, correction, the distance they have to travel to get to the 200-day it could be quite high, and that's sort of true within the gold space. And as we sit today, we've had a bit of a correction in the broader U.S. market, but Canada has sort of been consolidating, sort of, and then staying fairly resilient through this. And as I sit here today, I look at the TSX trading just at, or maybe even slightly above, the 50-day moving average. So again, getting in deeper into technical terms, this is more of a shorter term moving average. This has been a very strong level of support, whether you're looking at the TSX or even some of these other more AI sensitive or higher momentum names. The S&P 500 has sort of bounced off its 200 days several times, and the TSX sits, like I said, just above it. And we're over 140 days. We might be even close to 150 days of the TSX above its 50-day moving average. And what's interesting about that is that's the third largest um, period of time above its 50-day moving average in history. And so that's sort of this idea that we're seeing strength in the Canadian market, we're seeing strength across a number of stocks and sectors, and we're actually seeing that sort of resiliency of that strength and sort of that persistence of that strength sort of being shown by staying above its 50-day moving average as well. So that's another a strong point. If you think about the U.S., and I'll use the Russell 1000 just to sort of get a more broader
Sure.
capture of the U.S. market, only 55% of the stocks in the Russell 1000 are above their 50-day moving average. So the U.S. A lot of talk about the U.S. market has become so concentrated in a very small number of names. The weight, the performance, the earnings contribution, the valuation is driven by a very small number of names, and that has sort of implications on its own. But for Canada, we're seeing some of that breadth, despite gold being a large contributor. So it's something that's a really important, I think, to note to the listeners, that the TSX has been strong, gold has been strong, but it's not just gold driving the returns for the TSX.
Yeah. So for your mom, then that's a great explanation of breadth, which we love Canadian breadth. We also like bread. Another Canadian band your mom probably liked back in the day. But I got some stats for you on this, and I wanted to focus on the makeup always of the Canadian market because it is distinctly different from that of the U.S. in terms of the composition that makes up the Canadian stock market. Which again, we're sometimes making that direct comparison, Canada, US, and we sort of think of Canada and the US right beside each other, big trading partners. But what makes up the bulk of the Canadian equity market is very different from the way the US is allocated. And you need to remember that at times when different parts of the market are leading or falling back.
Yeah, that's one of the things that we highlight in some of the presentations as we're making to advisors right on the road is that when we talk about the strength of the TSX and we talk about the breadth of that sort of performance coming from a number of different sectors, not just gold. And then we talk about the underlying earnings growth story in the TSX, which I think sometimes is lost when people think about U.S. markets and you point to the earnings growth and you talk about AI and these magnificent seven or the top 10 companies in the S&P 500. The earnings growth is spectacular coming from these companies. I always say they don't call them the mediocre seven; they call them the magnificent seven for
Yeah.
a reason. And so it's worth noting that we have to sort of explain the earnings story in Canada. The one thing to note is that we've just wrapped up third quarter earnings for the TSX. With close to about 90% of the companies have reported. And the year over year earnings growth in the third quarter, as reported, is up 17% for the TSX as a whole. And that's a pretty big number. And the quarterly earnings number in aggregate for Q3 actually it just eclipsed the record that we saw in Q2. So we're at sort of record earnings levels and showing strong earnings growth for the TSX. So the thing we need to focus on is the composition of the earnings growth. So if you say analysts are forecasting sort of 12 to 13% earnings growth for next year, that can be a bit of a surprise given the uncertain outlook for the overall economy. But the thing we have to remember is that the earnings composition for the TSX is very different than the overall economy. So, I have a chart that I've been using in a presentation that sort of breaks down the GDP components across all the different sectors, and then compares that to the TSX weighting. So if you think about, one of the things that stands out the most is that the real estate composition or contribution to GDP in Canada is probably one of the highest sectors. It's just under 15%. And the real estate composition of the TSX earnings is about 2%,
Yeah.
something like this.
Yeah.
And so manufacturing, healthcare, these are all big drivers of the overall economy, but they're not big drivers of the earnings pool in Canada. Of course, we know the earnings pool in Canada is dominated by the big sectors, energy, financials, mining, and so those things can have a very different, be on a very different cadence of growth in terms of the earnings pool relative to GDP. The one thing I would note is that one of the biggest contribution to the TSX earnings pool is coming from financials and coming from banks. So we have to be mindful that the banks are really a function of all the rest of the sectors of the GDP. So if we do see a period of economic weakness, or if we see this sort of slowdown that we've seen over maybe the last couple of quarters continue on or get worse, that will start to impact bank earnings. But there's lots of ways that TSX earnings can go up, even in the face of a sort of slightly uncertain economic outlook for Canada.
Yeah. And Stu Kedwell and Eric Lascelles both talked about the trade negotiations that are going on right now and the potential that we get, at the very least, a better than expected outcome in the trade negotiations. And that would help the Canadian economy and certainly help policy in terms of driving spending and policy towards economic growth, which again then ultimately spills out. And you say there's not that direct connection between earnings and the overall economy, but a better economy, a better economic backdrop is going to be better for earnings in general. So that's one reason. If you again, as you talk about the banks and financial services, and ultimately materials as well, that economic growth is a wind behind the sails as opposed to a wind against you.
Yeah, I think we have been concerned. One of the things I am worried about is that I agree with your point that all of this sort of trade headlines and rhetoric and uncertainty, it's been a lot of noise, and it's been a lot of noise that will hopefully lead to a resolution that's certainly not as bad as what people once thought. That plus the fact that it's been a nice stiff reminder, a good kick in the pants for our new Canadian government to get out there and reestablish some trading relationships outside of the U.S.
Yes.
Diversify our portfolio, as they say.
Yes.
If you've got great stocks in your portfolio, that's great, but you need to have some other stocks in your portfolio as well. And we are seeing that. There's that's happening every week. There's headlines not only about the establishing better trade relationships with other countries, but also doing more investment inside of Canada. There's been a number of energy infrastructure or more broad infrastructure projects being announced that will go through a fast track process. So those are all great things, and those will benefit us in the long term. What I worry about is the potential for I'll call it an air pocket of, businesses have been a little bit on hold. And we're approaching, we're a year since the election, and so businesses have been sort of on hold with this uncertainty in terms of capital investment, major hiring decisions, things like this. And that's going to start showing up, and it perhaps is already starting to show up in some of the economic data. So my concern is that while the right things are being done for the long-term benefit of our economy, which is probably more important, that's that the stock market will probably look towards that. But I do worry about in the near term, there has been this pocket of uncertainty which has held everything on hold, which may show up in some slightly weaker economic data. But that would be more of a shorter term effect that, it might get the market a little bit rattled in the near term, but we do think that over the long term, the market will gravitate towards those sort of more positive tailwinds as you highlighted.
Yeah, and I know you spend time as you've already mentioned out a little bit traveling across the country. I'm out all the time, and when I'm talking to business owners, or business people, period, who are working in businesses where trade is an important part of what they do and their operations relative to the U.S. That yeah, that's just been a cloud hanging over everyone's head. It's had an impact. Uncertainty creates paralysis in some ways. When I don't know what to do, because I don't have a definitive answer or definitive information around how to make that decision, and clearing that up is going to help. But as you say, a whole year of that uncertainty. It's hard to believe the years move fast, but it has been a year since the election and that cloud over everyone's head. So it'll be nice to remove it one way or the other, hopefully positive, and then we move forward. But I do think to some extent the TSX is reflecting a again, it's going to be better, much better than the worst of what we thought back in January and February, March of this year.
Certainly. And yeah, I think about those days that we spent out on the road through February, March, April. Those are some pretty the headlines were pretty coming at us fast and furious, and to be able to get up in front of audiences and say that there is some underlying sort of strength in the Canadian market, I think was hopefully helpful, and I think our clients benefited from that. The When we think about the going back to the earnings drivers of the TSX, the two big pools are energy and financial. So we could talk about gold a little bit, perhaps some puts and takes there, but energy and financials are the big drivers. I talked about earnings wrapping up for most of the
Sure.
companies in the last couple of weeks. The banks, they're going to be set to report their Q4 and sort of year-end numbers in the coming weeks. The expectations, banks have been strong, but they've really most of the strength in banks has sort of come from those March, April lows. They had been weak heading into that, and they actually had been weak over the last 2 years. And we've seen a lot of strength, a lot of sort of recovery. The valuations have improved. I think the market is bringing forward some of this potential strength in the face of a recovery. I think credit is still a concern for people looking at banks. The measurement for credit health is the provision for credit losses, PCLs. PCLs are expected to be peaking sort of in these quarters. We saw a little bit of improvement in PCLs. At least they didn't get worse last quarter, and the expectations for bank management teams, CEOs, analysts following the banks, and I think investors where they're trading at today is that the credit conditions will continue to improve as we head into next year, and that will be helpful. And if you think about the rest of the earnings drivers of the banks are very, very strong. Capital markets activities have been strong, and actually we've seen a pickup in capital markets activities even in the last couple of months with M&A, with sort of the deal flow, some equity deals coming to market. So there's an expectation that capital markets activity has picked up and will actually start to continue as we head into next year. The wealth business, as we know, has been quite strong, with markets just
Yeah.
being generally higher and seeing some of that cash from the sidelines coming into investment portfolios, and so that's good for the wealth business. And then the other thing that you and I have work for a bank. We've been, the cost cutting there's been a big focus on cost cutting over the last number of years. And so, just like any business, when you are able to keep your cost structure down, or if you focused on reducing your cost structure, and now you're adding incremental revenue on top of that, that's something we call positive operating leverage, which has really been helpful driver for earnings growth. So you have this scenario where you have, rising revenues on a more efficient cost structure, which is going to be helpful for earnings. It's going to be helpful for return on equity, which is a big driver of sort of bank valuations. And you do have this risk around credit. And I think I've talked about this before, is that we're refinancing two-thirds of the bank's mortgage book this year, next year, and the following year. And these are mortgages that some of them were underwritten 5 years ago in a very low interest rate environment, and interest rates have gone up. They're not as high as they were. Bank of Canada has been very supportive, and so mortgage rates are lower than they were, say, 2 or 3 years ago, but they're still much higher than where they were 5 years ago. So that's an important, for the Canadian consumer, your monthly mortgage payment going up 10 to 15, maybe 20%. That's your biggest single monthly expense for most Canadian
Yeah.
households. And so having your biggest monthly expense going up by 15, 20%, you're going to have to make some choices with where that's going to come from. And then the most important thing to note on that front is the employment situation. We were just a snick under 7% unemployment, which is a high number, and hopefully it doesn't get much higher. But if things were to sort of deteriorate, that would be a risk. Now, the offset to that within banks is that the banks are very well capitalized. I would say that I think every bank except for one has is buying back stock. So we could see, as banks sort of report their fourth quarter, an update on how they're returning some of this excess capital to shareholders through share buybacks and dividend increases. So, it's not a perfect situation in terms of the visibility of earnings growth for banks with this sort of concerns around credit and the economic sensitivity. But the offset to that would be very well capitalized. And then in the meantime, the other drivers of bank earnings have been very, very strong. So valuations have started to reflect that, but I would expect to see some earnings follow through as we head into next year.
Yeah, steepening yield curve, and I mean, hopefully, as well, if you look at the Canadian economy, you're in Vancouver, I'm in Toronto. Those have been, relatively weak housing markets, and particularly in some specific areas like condominiums, small condominiums, and any improvement there is gonna help, and then if you get the housing market moving in the right direction again, that helps the banks. So there's some, and again, banks, financial services, big part of the Canadian market. Why don't we shift over to energy, because again I think the snapshot or the quick look that people would take on the energy sector is, well, okay, well, oil's been floating right around $60, actually been below $60 a barrel at different points in time, but there's actually some positive news out of the energy stocks.
Yeah, so a few things going in the energy sector. Oil's been weak, and it has been weak for most of this year. I think it's down 15-20% year to date. And it's basically been declining since, for the last couple of years. We had that big spike up with, Russia, Ukraine. We spiked up north of $100, and we've just been steadily grinding lower, which has been a headwind when we talk about those earnings forecasts. As the estimates come down, as the oil price comes down, the estimates come down for the energy stocks, and so they've been sort of fighting that negative headwind where some of the other sectors have had a positive tailwind. So it is the one part of the market where the earnings forecasts have been coming down, and that's a big driver of the TSX earnings pool. In terms of the oil price, I don't have a strong view. I think every time I get on here and we talk commodities, the one
Yeah.
thing I say is that they're really hard to predict and it's really hard to forecast. But we have to be mindful of it. The one thing that the one thing I would notice is the narrative and the sentiment towards oil is very weak. So we're not in a very robust bullish environment for the oil price. But meanwhile, the stocks themselves, the oil and gas stocks, particularly the large cap Canadian names, oil producers, they have not been as weak. So if you've looked at the oil price and if you read some of the headlines around oil and demand for oil, you would be like, oh, these stocks got to be in a lot of pain. And then you look at the charts and you say, wow, actually they're acting okay. And there's a couple of reasons for that. And or at least I suspect there are a couple of reasons for that. One is especially the large Canadian energy companies, the big, sort of large cap oil and gas producers. They have been working so hard fighting a declining oil price. They've been working on their cost structure. They've been very disciplined with their capital. Their business models, and they've been forced into this, but their business models are very resilient to weakening commodity prices. Let's not kid ourselves. If the oil price went down another $10 from here, these stocks will be under pressure. But their balance sheets are in much better shape. Their cost structure is in much better shape. Their free cash flow generation is in much better shape today in a period of sort of weakening or declining commodity prices than it has been, say, in the previous decade. And so the business models are much more resilient and sustainable in a period of declining or low oil prices. And that's really important for us. We're long-term investors who understand that I cannot predict the oil price. So
Yeah.
I need
Yeah.
to feel comfortable that if the oil price, if the commodity situation weakens further, that the company's balance sheets are in good shape, that they're going to survive. So they have strong balance sheets. Their cost structure is low enough so that they can keep generating cash flow in a weaker commodity price environment, and they're the way that they allocate capital less towards growth, more towards sort of maintaining the current level of production. That will hopefully allow them to continue to generate positive, not only just positive cash flow, but positive free cash flow. So the business is
Yes.
sustainable, the balance sheet's in good shape. Um, Companies are still focused on returning some of this excess free cash flow to shareholders. Dividend share buyback are still on the table for these companies. Balance sheets are in really good shape. So, when we talk about energy stocks, when we think about scenarios, I don't necessarily think about the high case scenario, like if oil went back to 80 or $90. These stocks will be fine. The
Yeah.
stocks will go up. They'll be in great shape. We got to think about the downside scenario, and they certainly wouldn't be pricing in a significantly worse oil price than what we're seeing today. But the good news is that they're very resilient to that sort of a weakening. And the other thing that commodity picture, the other thing that's interesting, and we talked about earnings, we talked about earnings growth, and we haven't talked about estimate revisions as much, but estimate revisions have inflected positively in Canada, and that's something that's happened sort of over the last number of years. But really, at the midpoint of this year, we saw this sort of uptick to estimate revisions, and that's really important because that's what the market is thinking about. It's not so much what are the earnings and what's the earnings growth, it's where's the earnings growth going. And what's interesting is that the oil stocks, not a lot has to happen for the estimate revisions to be positive. So you could actually have a flat commodity price, but you'd still get the earnings to be
That's
positive
right.
because the estimates stop going down. That's maybe something that's a little harder for people to wrap their heads around, but it's the rate of change is the way I'd like to think about it.
Yeah.
And so, the oil price has gone from 80 to 60. That's been a negative headwind for earnings. But if the oil price goes from 60 to 60 or 60 to 58, that's going to be there's still could be positive estimate revisions because of the oil company's cost structure and share count reduction. They could actually generate positive earnings growth or even positive year over year earnings growth, even if the commodity price is flat. So that's something that's important to note in terms of the driver of the earnings forecast for the TSX as a whole, in particular for the energy stocks.
And you mentioned the banks and the number of banks that are buying back stocks in the energy sector. The larger energy companies are still quite active in terms of share buybacks. No.
Yeah, yeah. A lot of them have sort of created a more systematic capital. Like, they've really tried to show some improved discipline around capital allocation. We've talked about this. In the previous decade, oil prices were strong; they were growing production. This time around, oil prices, they're not strong, but they're focused on, and they put a systematic framework in place to show to the investment community, to show to shareholders that, hey, we are being disciplined about this. So they're going to take, some element, some component of their free cash flow, and they're going to allocate that to debt pay down. And when they get their debt paid down to a certain level, all excess remaining free cash flow will go towards dividend and share buyback. And the market has received that welcomely. That shows the discipline. There's a construct to sort of a scorecard to measure them by, and companies are staying quite focused on that. We are seeing some M&A within the sector, which is kind of an interesting um, thing to note, because that sort of shows that these companies are feeling good about their businesses, that they're willing to sort of combine and merge with other companies, and sort of, in order to do that, you're going to have to issue shares and take on a little bit more debt, but a belief in the combined entity that it's going to be greater value to shareholders going forward. So that's an interesting sign that we're seeing some M&A and some consolidation within the industry. Again, that's going to drive even more efficiency on the cost structure and help drive earnings without the need for significantly higher commodity prices.
Yeah, and we should mention, because we've got lots of new listeners, and please share the podcast with your friends and family. Subscribe on anywhere you get podcasts, and also give us some likes on YouTube, because Scott's looking pretty sharp today. That's worth a like on its own. But M&A is mergers and acquisitions. And so when you see that kind of activity, that means even the firms inside are seeing some value in the share prices, which is nice. And then the big thing about share buybacks, and we should make this point, is, you take a company, the earnings, the actual earnings of the company might stay flat, say year over year. But if they bought back shares, fewer shares means the earnings per share, which is really what drives your valuation, your earnings per share would go up. And so the math works better when companies are buying back shares. And that's why, you often and you think of where companies generate shareholder value. It's in dividends, because again, that's cash that they're paying out directly to you, or share buybacks, because again, that's cash reducing the number of shares and making your shares on a relative basis technically worth more. So these are good things that are happening. So Scott, I'm going to I think we always run a little bit long, which is fantastic. It just says we need to get you back more often. I did want to talk about gold. So
Right.
we're gonna get you back very shortly and do a special edition on gold and mining, because if you rearrange the letters in Scott G. Lysakowski, it's I know gold. So you can check that out for the listeners. Take a piece of paper. You can work that out. Scott, always great to catch up with you. Enjoy the skiing. Glad to hear that's up and running. I know that's as it's raining and dim and dismal in BC every day, and people get down. It's good they can drive up the mountain and get some activity, some physical activity in, and brighten up your day. So, but thanks again, and
Yeah.
enjoy the. By the way, there's a I think a first time since 1952, the polar vortex is going to come down into sort of Regina, Winnipeg area over
Oh,
the next
lovely.
week and produce an incredible cold front. So you'll enjoy that. That'll wake you
Okay.
up if you're not
I'll
if you can't find good coffee there.
I'll pack the parka. That's a good tip. Looking forward to it. Looking forward to being out in the road and seeing some of our advisors and clients. But yeah,
Yeah,
thanks, Dave. And yeah, the ski season, the prospect for ski season is what gets me through these dark and dreary days. If it's raining in Vancouver, I'm just hope it's snowing up in the mountains. So that's going to get me going.
excellent. So so again, travel safe, and we'll talk to you soon.
Thanks, Dave.
This recording has been provided by RBC Global Asset Management, Inc. for informational purposes only and is not intended to be investment or financial advice. You should consult your own legal, accounting, tax, investment, or financial planning advisors before engaging in any transactions.